Have you ever stared at a price chart and just felt like it was trying to tell you something? You know, like it's leaving behind little breadcrumbs, clues about its next big move. Well, you're not wrong. And one of the most powerful clues it leaves is this kind of hidden vacuum, an area that price just feels compelled to return to. Today, we're going to pull back the curtain and see exactly what that's all about. Welcome to AI Explains ICT. In this video, we're going to be diving deep into a really key concept from the ICT mentorship, the liquidity void. This is all coming from the core content, specifically Month 4, Episode 10. All right, before we really get into the weeds, just a couple of quick things. First, you might want to grab a pen and paper or open up a notes app. This is some foundational stuff you'll want to remember. And second, this is super important, a little note on terminology. In this particular lesson, ICT uses the term liquidity void. Now, if you followed his more recent stuff, you'll know he's more likely to call this a fair value gap. Just know they're the same concept. So when you hear liquidity void, just think fair value gap. Cool? Let's go. Okay, so let's get right to it. The first big question is, what in the world actually creates one of these voids? Well, it all boils down to one thing: a sudden, aggressive imbalance in the market. So, what are we really talking about here? A liquidity void is basically a breakdown in the normal auction process of the market. It's a range on your chart where price moved so incredibly fast in one direction that it left behind this area of, well, inefficient price delivery. Imagine a highway where all the traffic is screaming down the northbound lanes and the southbound lanes are completely empty. That's kind of what this is. And you don't have to take my word for it. Here's how ICT himself puts it. When he says one side of the market liquidity is shown, that's our highway, right? All traffic is going in one direction. And those wide or long one-sided candles he talks about, that's the visual proof. It's the chart screaming at you that the other side of the market, say the biders in a big down move, were just totally absent. They weren't there. So how does this actually happen? Well, it usually unfolds in 3 pretty simple steps. First, you've got a balanced market. Price is just kind of chopping sideways in a tight little consolidation. Then, bam, step 2, displacement. This is where smart money shoves all its chips onto the table, causing a massive, aggressive, one-sided move. And that, of course, leads to step 3, the imbalance. A void is left in the wake of that move, an area where there was almost zero participation from the other side. Okay, so that's all the theory, but what does this actually look like in the wild, on a real-time chart? Let's switch gears and see how you can spot this pattern for yourself. Now check this out. Look how clear the story is on this chart. You see that balanced price action inside the orange box, right? Just a tight little consolidation. And then, look at that aggressive move down. Those long red bearish candles with practically no wicks at the bottom, that is your liquidity void. It's a perfect picture of pure, unopposed selling pressure. So why does this matter? Who cares, right? Well, you should care, because that void, that big gaping hole of inefficient price action, it acts like a vacuum. It's like a magnet. The market has this incredibly high probability of eventually being drawn right back into that range to, rebalance the books and trade in that area it just skipped right over. And this is where things get really, really interesting. We don't just spot the void and say, neat. We can actually anticipate the market's return to it. So let's watch how price gets pulled back, almost inevitably, to fill that gap. But hold on a second. It's not always a straight shot back to the target. Before price makes a run for that void, look what it does first. It actually dives lower. See that brown arrow? It's going down to run the sell stops that were sitting just below those previous lows. This is a classic smart money maneuver. They go hunting for liquidity before they make their real intended move. And then, only after grabbing that liquidity, does that vacuum effect finally take over. You can see price just aggressively rallies all the way back up to that 1.0476 level, and boom, the entire void is filled. The imbalance has been corrected, the market has returned to a state of balance. Okay, so we've seen a void form, and we've watched it get filled. That's a pretty powerful observation in itself. But the really critical question for us as traders is, how can we actually use this knowledge to frame a high probability trade? Let's just pause and think about this for a second. The market showed its hand, right? It showed us it wanted to go lower with that first huge aggressive move. Then it came all the way back up to rebalance things. So what do you think is likely to happen next now that the void is all filled up? All right, here's where you need to pay really close attention. This is a subtle but incredibly powerful clue. After price fills that big void and retests that 1.0476 level, look very closely at what happens next. A brand new, much smaller imbalance, what ICT calls a price gap, shows up right between those candles. This is the market tipping its hand again, basically signaling, hey, that original selling pressure, it's back. And that little gap, that becomes our high probability entry point for a short trade. Think about the logic here. The market's bigger story is bearish. It just finished its rebalancing business up high, and now this new little gap confirms its desire to head lower again. So where's the most logical target? Well, it's that pool of liquidity we already know is waiting down there, the sell stops sitting below those old lows. So let's wrap this all up with the key takeaways. Voids, or as we now know them, fair value gaps, are simply imbalances that price absolutely loves to fill. Price has a high probability of returning to these areas. But the real pro move is to wait for that fill to happen and then look for a new, smaller price gap to form. That little gap is often the signal that the original move is about to continue, and it can give you a fantastic entry for a trade. Hey, if you found this breakdown helpful and you want to see more content just like this, do us a huge favor and hit that like button and subscribe to the channel. It really, really helps us out. And of course, if anything was unclear or if you just have questions, drop them in the comments below. A real human will get back to you and help you out. Thanks for watching, and as always, safe trading.